Welcome back to Trading Hour on CNBC TV18. Well, brokerage house UBS has written a report discussing India's potential to grow as a manufacturing hub and potentially replacing China as a factory to the world. Tanvee Gupta, the chief economist at UBS Securities, joins us now to discuss the report further. Tanvee, hi, great to see you on CNBC TV18. Thank you so much for joining us. You know, these drawing parallels with China has been something we've been doing for almost a decade now. But where do we stand at the moment? And, what has your analysis been? What's the key takeaway from your report?
Sure. So what we have done is, specifically since the pandemic, or I would say in the past couple of years, economic fortunes and outlook for China and India has been quite divergent. So you would have seen that the China's economic recovery has been weak, especially since the pandemic. Whereas if I look at my India's economic growth, that has been pretty strong so far. And if I look at China, it is facing a lot of structural challenges, including a rapidly aging population. And when we look at India, it is a relatively young and a rising labor force and a far friendlier external environment domestically, as I would say. So we have been getting a lot of questions, can India be the next China? So in this report, what we did was we didn't simply say that whether India can grow rapidly over a long period of time and become as large or as rich as China today. I mean, at some point, this is not difficult to answer. With population as large as China, we are of the view that Indian economy at some point will become as big as China. But we try to give a framework on how India and China economic fortunes will pan out, especially in terms of manufacturing. Second is domestic market, and the third is as a implications for the global commodities and energy markets.
Okay. No, I have one follow-up. You said that, when you talk about a rapidly aging population in China, that's a big issue. And on the flip side, perhaps you're also looking at how a demographic dividend in India, right, is something that we could hit the peak at 2040. But there are a lot of naysayers who believe that from a demographic dividend, we could actually be staring at perhaps a demographic disaster because of the lack of jobs, at the rate at which the young population is growing and the rate of jobs is not matching up. We could be in for some trouble. Would that be something to consider in your thesis?
Okay, so let me connect with what we are trying to say and from a manufacturing point of view. So if you look at manufacturing, because that is one sector where we can create a lot of jobs, at this point, as of today, I don't see India is likely to pose any serious challenge to China's overall position. I mean, India's share in global manufacturing is 3%, China is about 30%. However, from here to next 5 years, 10 years point of view, we think India has a very potentially favorable conditions for rapid growth in manufacturing. So your abundant cheap labor, because the labor cost in India is for manufacturing is one of the lowest across EM, improving infrastructure, policies to attract foreign investment, and most importantly, is a very favorable international image right now, which India has in terms of the global audience. At the same time, I think one big quality which India has, which I don't see any other Asian economy can replicate at this point, where your demographics could actually be a boom, is a potentially a large domestic market. And when I compare India with China, we realize that India today is equivalent to China in 2006, 2007, while our per capita income is equivalent to China in 2000. And I think that will be one key for a rapid manufacturing growth in the years ahead. So I think that is something which I will see from a very potentially positive, favorable condition that could work for India in terms of a demographic dividend.
Okay. So India's domestic consumption is one factor which differentiates it from the rest of the emerging markets. You've also, in one of, as a part of your framework, you've also raised the question that will India's energy and commodity demand grow like China's did over the past 2 decades, and will it have the same impact on the global markets? Where do you stand on this, and what are the thoughts one should keep in mind?
So if you look at China's data over the last 2 decades and the way China has evolved as a part of the global manufacturing space, it has an enormous impact on global energy and commodities market, specifically over the past 2 decades. When I compare it with India, we are already a large oil importer. We are already seeing that the coal imports are also on the rise. But when I compare China and where India is, I don't see that India will see a very similar demand pattern what you saw in China in the last 2 decades. We need to realize that even our GDP compositions are very different. India is largely a services-driven economy with more than 50% share in services as a part of our GDP. Manufacturing share as of now is only 13%. So even if we expect that 13 goes to 25%, we don't see that the growth is unlikely will be as capital and energy intensive, what you saw in the case of China. And at the same time, India's own resource availability and a different urbanization pattern also means that the country is unlikely to follow China's past path of imports of base metals, especially iron ore.
Economists also make forecasts, right? You all look far into the future, even though it's extremely hard to do that. So give us the numbers that you have in your mathematical model. You said India's share of manufacturing in the world is just about 3%, while China is at more than 30%. Now, how does that change, say, in the next 10 years? Do you have any number to that? And also, what can go wrong to this thesis? Because you spoke about many factors which are aiding it, favorable regulations, India is constantly upgrading its infrastructure, but there is also a possibility that China may, on the regulatory front, maybe change the game.
Absolutely. So if I look at from a base case, so 3% right now is India's global manufacturing share. We think it can clearly double over the next 1 decade. But there are a lot of risks which could hold back India from becoming the next China. And I think the first and the most important is infrastructure bottleneck, especially the last mile connectivity and a very unstable power supply. At the same time, while we have a very young population, labor productivity is another big concern. And the third will be the regulatory laggards. I think these are the three big, bottlenecks that India will definitely need to work upon to boost manufacturing. I mean, we are seeing some progress in land acquisition, even though it is slow, but it still continues to be a hindrance for large-scale infrastructure developments. India is working on reaching free trade agreements with several countries that could actually help in boosting export potential over the next 1 decade. So I would say there are a lot of leads, plus there are a lot of laggards, and we need a good balance on both that counts and a lot of policy intervention in helping India go to that path what China saw in the last 2 decades.
Okay, a lot of work needs to be done. Thanks a lot for joining in. I appreciate your time here on CNBC TV18. Let's step into a quick break. On the other side, we'll get you more on the markets. Markets are doing very well at the moment. Hopefully, that trend will continue. More on that coming up.